All right, welcome everybody. Thanks for joining me for today's presentation. Are you missing Roth IRA opportunities? This is the latest in a Prizes Ask Me Anything series. This quarter I'm doing them twice a month, so I'll have one more this month on the 25th. And then starting in April, I'm going to go to just the fourth Thursday of the month. I'm going to cut down the frequency just a little bit. So here's the agenda for today. I have four main questions that I'm going to try and address during this presentation. The first is, should you contribute to a traditional IRA 401k or a Roth IRA 401k? Why should you consider a Roth conversion? It's the second one. The third one is, what's a backdoor Roth IRA? And the last one is a non-deductible IRA contribution a good idea? If anybody has another related question, feel free to throw it in the chat and I'll be happy to address it as well. All right, so the first thing we're going to talk about is, why does this matter? Why are Roth conversions and Roth IRAs, why are they relevant? Why do we care? It's really, a lot of it's about taxes. So you have to think about this from a tax perspective. You have three different ways that you can save for your retirement. The first is the one that's most often overlooked, but probably has the most value because it's triple tax-free, and that's a health savings account. And the reason that's triple tax-free is the money that goes into the account, you don't pay tax on it. You can actually invest that money, or it can sit in a bank account, that's up to you. But either way, whatever growth or earnings that money gives you, that's tax-free. And then when you pull the money out, as long as you have qualified medical expenses, and those qualified medical expenses don't have to be in the year that you take the money out, they can be any time during the period which you were contributing through that year. If you have some type of qualified medical expenses, when you pull the money out, it's also tax-free. So that's 3 times that it's tax-free. Then there's the savings that are double tax-free, and that would be either your 401k, 403b, or your traditional IRA. And that's double tax-free because the money that you go in, you get a tax that you put in gives you a tax break. The money grows for free, so that's a second tax break. But then when you pull the money out, you pay tax at your regular tax rate. And then the other type of double tax-free is the Roth IRA, which is, one of the focuses today. And a Roth IRA is also double tax-free, but it's different than the traditional IRA, because with a Roth, you don't get a tax deduction for the money that goes in, but you do get one. You have no tax on the growth, and you also pay no tax when you pull the money out. And the last type is a taxable account, a taxable brokerage account. And so that's just your regular brokerage account. So the money that goes into the account, you've already paid tax on. The growth in that account, you pay tax on only the growth piece when you pull it out. That's different from a traditional IRA, because with a traditional IRA, if I put in $100 today and it's worth $150 when I pull it out, I pay tax on all $150. At least for the brokerage account, one advantage it has relative to that particular element of an IRA is I would only pay tax on the $50 of gain in that case. And then the income earned and the brokerage account is fully taxable. I see there's a question about passing on an IRA and a Roth once you're deceased. And so I'll talk about that a little bit later in the presentation, and also should want to allocate some to the grandkids. So Bernard, if I don't get to that question, please make sure that you ask, if I don't remember it, I should, because I have it in the chat, but if somehow I don't discuss it, make sure to remind me at the end and I'll be happy to bring it up. So the first question is, should you contribute to a traditional IRA 401k or a Roth IRA 401k? Should you contribute to one, the other, or both? What do you guys think about that? And you can put your response in the chat if you like. So the short answer to that question is yes, and you should contribute to both. And the reason that it makes sense to contribute to both is you want to have accounts that are treated differently for tax purposes. That matters when you reach retirement. While we're working, we're accumulating assets. When we get to retirement, we're in the decumulation stage. And so we want to make sure that we have a tax efficient way, or as tax efficient we can, in terms of how we take the money out of the accounts. So having different account types gives us the ability to pull money out and maybe not pay tax on it, to pay ordinary tax rates on it, to pay capital gains. There's a variety of different things. So you want to have those different types of accounts because that can make a really big difference. The other thing to think about is that when you have an IRA or a 401k, when you reach age 72, then you do have required minimum distributions. If you have a Roth IRA, there's no required minimum distributions. There's also advantages that come with that Roth treatment, which I'll talk about more as we go through the presentation, that a Roth IRA or 401k has over an IRA if you pass on and leave that money for your kids, your grandkids, whoever the case may be. So let's look at the question, should I consider a Roth conversion? These are really important questions. I suggest you write these points down because they're going to get to the crux of the issue. The first question is, what's your taxable income? Why does that matter? Because your taxable income determines your tax rate. And part of this analysis is figuring out what rate of tax are you comfortable paying. And that should kind of be the maximum that you want to pay in a given year, which is part of the second. What is that maximum tax rate? Like if I look at the current year's tax, we started at 10%, we go to 12%, then there's 22, then there's 24, then a big jump up to 32, and it peaks out at 37. So you want to figure out which one of those rates you're comfortable paying, and that's based upon what you're paying today versus what you might pay in the future. Another question, is possibly lowering the tax rate for your surviving spouse important to you? What do I mean by that? Think of it this way. When you're married, you file a joint tax return. The income levels for each of those tax brackets that I just laid out are different for married versus single filers. When you pass, while your Social Security income is going to go down because now there's only one person getting income, and if you have a pension, that income may or may not go down depending upon how that's structured. But your IRA money normally is going to pass from you to your spouse, which means that they're going to basically continue to take your R&Ds. Well, if we do some Roth conversions earlier, that's going to lower the size of our future RMDs, which is a way to help manage the tax rate for your spouse, because of the fact that even though they'll go to a single return filing status, if their income's lower because we did these Roth conversions earlier, it could be a way to potentially lower their tax rate. And the last thing is, do you hope to leave money to your heirs? Why do I say that? Because it used to be that if you inherited an IRA, you had a stretch IRA option, which meant that you could take the IRA money out over your lifetime. And that's based upon IRS tables. So if your estimated remaining life was 25 years when you inherited an IRA, you took out 1/25 of the balance every year for 25 years. At the end of 2019, they passed the Secure Act. The Secure Act did away with the stretch IRA rules. It replaced that with the current rules, which say you have to take the money out in 10 years. If you have a Roth IRA that you passed on, your beneficiary still has 10 years to take it out, but it's not taxable. If it's in a regular IRA account, it's taxable and they have to take it out over 10 years. And that could have a dramatic impact on their tax situation because it could bump up their tax rate. Some people refer to this as a tax bomb, right? You want to make sure you want to think about, what does this do to your kids' income or your beneficiary? If it's your wife or your husband and your spouse, it doesn't matter as much because they can kind of step into your shoes, and that 10-year period doesn't generally apply to them. But if you leave it to your heirs other than your spouse, that 10-year rule applies. This is really all about managing your tax bill, but not just today. You want to think about what your tax bill might be in the future as well. And if you're having trouble answering these questions, a little later, I'm going to give you an opportunity to address them with me. Next question that I asked up front was, I talked about backdoor Roth IRAs. Do you know what those are? Well, backdoor Roth IRA is a way to make a Roth IRA contribution if your income level is too high to contribute to a regular IRA. What you do is you fund a non-deductible IRA contribution. So you're still limited to $6,000 if you're under age 50, $7,000 if you're over. And then you immediately convert that into a Roth IRA. But you have to be careful because if it's not structured the right way, it can be taxable. The easiest way to do a backdoor Roth IRA and make it not taxable is if you have a work 401k plan. You don't want to have a traditional IRA because the work 401k or 403b plan isn't taken into account, that balance for the backdoor Roth conversion or backdoor Roth IRA transaction. If you have money in a traditional IRA, it does, and that's how come some of it can be taxable, some or all. Remember, when you're doing a backdoor Roth, income limits don't apply. And then this gets to the next point or next question: is a non-deductible IRA contribution a good idea? I say it's a good idea if you're going to immediately convert it to a Roth and do a backdoor Roth. The pros of the non-deductible IRA: income limits don't apply. It is a way to put money into a retirement account and get some tax-free growth. But the cons are a portion of your distributions may be taxable because so that means you have to track your basis. You have to know how much you put into the account, how much is growth. And then when you pull the money out, when you made this non-deductible IRA contribution, some of it's going to be taxable, some of it's not. At least that's the likely outcome. That's where the backdoor Roth has a benefit, because with a backdoor Roth, that contribution, you don't have to worry about that growth. It's already a Roth, so it's just like a regular Roth, and you don't have to worry about paying tax on any portion of the distribution. The other thing to keep in mind with any Roth IRA that you set up is it has to be open 5 years before you're allowed to start taking money from it. So if you haven't reached retirement yet, even if you want to put a small amount of money in, it's a good idea to set that account up so that you don't have to worry so much about that 5-year rule. So other things to think about: these are the exceptions that allow you to take money out of your non-deductible IRA: saving for college, birth or adoption, getting married, buying a home, you need money to care for your children or your parents, or you start a business. Those are things that you can take the money out for, but beyond that, it can be hard. So like I said, you want to be careful about making a non-deductible contribution because it can have tax implications later on that people don't realize. So let's talk about tax rates and why all this matters. I used to work in the tax department for Deloitte, and every year when I started with Deloitte, the government there'd be conversations about changing tax rates. And we still have those on a fairly regular basis, but I think it's not quite as frequently as it was back then. And every time that would happen, there'd be all the big think tank guys in Deloitte would put out their thoughts about what that meant and how you could deal with it. And what I found out is that most of the time, what they talked about didn't happen. So my view about taxes became, I'm going to deal with the tax rates that we have today. If they change in the future, I'll adjust and deal with them then. But for right now, I'm going to go with what we have today. And what we have today is that the law that was passed at the end of 2017, that law sunsets at the end of 2025. So in 2026, we go back to the tax brackets that we had in 2017. So if you see on the left of this chart, we have the tax bracket for single filers and married couples filing jointly in 2021. And on the right, we have the 2017 rates. So remember I said absent any further changes, taxes are going to go up in 2026. The changes to tax rates in 2017, they sunset at the end of 2025. If you're a single filer earning $100,000, remember your IRA is part, and your Social Security payments and any pension you have, those are all taxable. Your tax rate is going to go from 24% today to 28% in 2026. A married couple with that income sees their top rate go from 22% to 25%. If your income went up to $160,000, singles they're going to see the rate go from 24% to 28%. And a married couple is going to see their income go from 22% to 28%. So you want to be careful about that because that can have big implications. And I'm going to give you some examples and show you exactly what I mean. So here's an example like the situation I just talked about. Say that you're 60 years old, your filing status is married filing jointly, your current taxable income is $130,000, your marginal tax rate is 24%. That means there's about $35,000 room left in your bracket, in that 24% bracket. Convert $30,000 to a Roth IRA today from your IRA. Assume 6% growth, right? And now when we get to 70, so you're paying $7,200 in taxes today. In 12 years, a $30,000 contribution is going to be worth about $61,500. No taxes are going to be due on that amount when it's withdrawn, and this will apply to you as well as your heirs. If you had 8% growth over those 12 years, that $30,000 would turn into $78,000. So you're saving, you're paying taxes today, but if we go by the tax rate tables, you'll pay a rate 6% higher, and the amount that you're pulling out is going to be even larger. Now let's think about when you get to retirement. Say that you're age 65. You've retired at 65. Remember, I just use that as a number. A lot of people think that that's when you can get your max, that's when you get that's full retirement age for Social Security purposes. It's not. For most of us, it's 67. If you're born between 1953 and 1960, it's going to be 66 in a certain number of months based upon the year you're born. But from 1969, your full retirement age is 67. But some people are fortunate enough to be able to retire at 65. So let's say that you're married filing jointly, it's your filing status. Let's say that your intent is to delay your Social Security benefits to age 70. Let's say your current taxable income from pensions and whatever else you have coming in is $37,000. And you have some cash and some other accounts that allow you to meet whatever other needs you have so that you don't need any more, you don't need to pull money out of your IRA. So your first thing is you'd say, you know what, I'm willing to pay up to 22% tax. That's 22% tax rate. So that's your marginal tax rate. Your room remaining in your bracket until age 70 is $135,000. And you continue to fill that 22% bracket through age 72. So that means at 70, 71, and 72, you have less than that $135,750 I have here to fill the bracket because you're going to start getting Social Security income at 70. The implications of this. So your tax bracket in retirement, based upon what we know today, is 28%. Your tax savings from age 65 to 69, that's $40,000 a year. No taxes are going to be due when that amount is withdrawn. This is going to apply to you as well as your heirs. The amount of your future RMDs are going to fall because you've recognized some of that income today. And there's something when you start at 65, if we're not on a company plan, we need to have Medicare. And your Medicare premium gets adjusted based upon your income. So that's an IRMA as an income-related monthly adjustment amount. And so if we do these Roth conversions, you want to be careful when you do them, but they can actually lower your future Medicare premiums. You also want to keep an eye on that as you're doing it so that you don't push your premiums up too much by the value of the Roth conversions. So what I'm going to do is the calculation is more complex for this, but I use software to help me with this. And I'm going to show you what kind of savings the software says you can generate by doing exactly the scenario that I've laid out here. So you can see here that I said the withdrawal strategy, the conversion target was ordinary income tax bracket. I said to fill up the 22 or 25% bracket, and that the terminal tax rate, I actually only have it set at 25% here. And the software shows that that gives a tax adjusted ending portfolio of almost $2.4 million more. And you can see where those conversions really take place. In this chart, there's a purple area that goes from around age 65-ish all the way up to 72. And you're filling up that with these Roth conversions. And by doing that, it shows you It adds a lot of value to your portfolio. There's no better way to analyze this than to look at your own situation. Again, in a couple more slides, I'm going to give you an opportunity to set up time with me to build your own analysis. It can help to put together analysis just like this with your facts and circumstances. This type of analysis is part of any financial plan that we do as well. So the next slide, there's three types of investors, right? There's those who need help and get it. There's those who need help, but they convince themselves they don't need it. And then there's those who can handle everything on their own. Most of my clients fall into that first group. Those in the second group, more than anything, they're likely procrastinating. Those in the third group can do at least some of this on their own. But remember, this requires combining investments with tax considerations. Doing that kind of analysis can be hard. If you're working on your own situation, you likely haven't done this before. You're practicing on yourself. I do this all the time. If you'd like some help, you can give me a call. I'd be happy to help you work through it. In addition, maybe you're experiencing a life event that could trigger an I need help reaction. Many folks I talk to are also worried about their spouse. One member of the couple usually takes care of things and they're comfortable with it. But what happens if that person goes first? Perhaps you also have just gotten tired of doing it yourself, or you want to reduce the amount of stress in your life, or the decisions you have to make have outgrown your comfort level. If any of those things apply, I'd be happy to schedule a no obligation conversation as well. The business of Apprise, it's continuing to grow. It grows through personal introductions from people we know and serve. If you could think about people that you might be able to introduce to Apprise, here's some things that we like to look for. We like to work with people who are interested in gaining a better understanding when they can retire and what retirement might look like. They're experiencing a life transition such as retirement, loss of spouse or parent, divorce, sale of business, major career change, inheritance. We definitely like to work with friendly people. It's a lot easier and a lot more fun. As you can see today from this presentation, income taxes are also a concern. We like folks that are receptive to professional relationships and those who are considering simplifying their life by delegating their financial affairs to a professional. If you'd like to arrange an introduction or you'd like to talk to me on your own, there's my phone number, or you can send me an email. Also, you can just use this link that's on this slide to go right onto my calendar. You can sign up for a free Roth conversion analysis. And if you're not on my distribution list, you're welcome to sign up for that as well. So that's it for the formal presentation. At this point, we're up to the Q&A. So Bernd, I'd like to address your question. So you asked, looking for information regarding passing on an IRA and Roth once I decease. Should one allocate some to the grandkids? Well, it depends. If they're under 18, remember that you can't allocate it directly to them because it has to go into trust because they're not old enough. But you can certainly do that. And you want to think about the tax implications. Again, if it's a Roth, it's a little bit easier because there's no tax burden on anybody. If it's a regular IRA, the kids are going to be subject to tax too, because though they don't have to start, the 10-year rule doesn't apply to a child until they're 18, so that they won't have to take those distributions right away. Really, the decision as to whether or not to allocate some to the grandkids, I mean, there's also a personal element to that as well, right? If you want to make sure that the grandkids get some, it's good to put it in trust for them. If you trust that the parents will take care of it and leave some behind after, for the future for the kids, or spend some of it on the kids, then you can give it to the parents. If the kids are over 18, that's where that whole thing that I talked about earlier with the taxability of the Roth versus the taxability of the inherited IRA, inherited Roth versus inherited IRA, it's different. The inherited Roth, there's no tax. The inherited IRA, there is. And you want to just be careful that when you're thinking about all this, you don't want to create, like I said, that tax bomb that suddenly makes your beneficiary in a much higher tax bracket, because when they add their income plus whatever they have to take over that 10-year period from an IRA, it can make a difference. I know I have some clients where, they're not to retirement yet, though they will be within the 10-year period. So what we've decided is we'll wait to take money out of the inherited IRA till after they retire, because it's a 10-year period. I can take it all in year 10 if I want. So we're going to wait till after they get to that period where they don't have retirement, where they don't have wages coming in. And then we can start to take money out of the inherited IRA so that they'll keep their tax rate down. Beyond that, that's all that I have, but I'm certainly happy to take any questions that any of you have at this point. You're all welcome to unmute and ask any questions that you might have. Or you can put them in the chat if you prefer that as well. All right, if nobody has any questions, then, wait, I'm sorry, I do see one, I apologize. With the high tax rate in Maryland, it looks like Roth conversions in Maryland versus, say, Pennsylvania could generate a large bill. Can you speak about that? So, I mean, a Roth conversion is taxable, and you're going to pay, it does create taxable income. So you do want to be cognizant of the state and the federal tax rates. So like, you want to look at your tax situation. Like what I recommend is looking at this situation usually like in the fourth quarter of the year, when you have a better handle on what your income's going to be for the year, and look and see what the tax implications are. Certainly, because of the fact that we're a high tax state in Maryland, it is going to add to your bill. So you want to just make sure that you're aware of that and take that into consideration as well. And ideally, by the way, when you do a Roth conversion, you want to try to pay the taxes with funds outside of your retirement accounts, because otherwise you're going to really hurt the value of the Roth conversion. And the other thing to think about too with Roth conversions is if we have market dislocations, you want to think about those as being really good times for Roth conversions. Like, for example, I had some clients that did Roth conversions. We did them last March when the market fell. And that really increased the value of the Roth conversion because, if you could convert when the market was down 30%, the amount of assets that you were able to bring over as part of that conversion was much greater. And then all that growth that you got as the market recovered, none of it's subject to tax because you timed your Roth conversion well. So, and I know it's really hard to time things specifically, but the idea that when you have a market correction or a bear market, that's really a good time to consider Roth conversion if you can manage it, because obviously sometimes when that happens, it has an impact on our jobs. And if your income goes down, you don't necessarily want to pay extra taxes by doing things like this. All right. Any other questions from anybody? All right, well, if there are no other questions, I'm going to end here, and I want to thank everybody for joining me. As I said earlier, I will be back again in 2 weeks with another webinar, and then from then on, it'll just be on the 4th Thursday of the month. Hope everybody has a great night. Thanks again for attending.